Do you know that knowing how to actually identify inefficient price action in the market and also how to actually trade them can actually increase your win rate up to like 80 to 90%? Or welcome back to my YouTube channel. If you're just watching my YouTube channel for the first time, make sure you smash the like button and also subscribe to the YouTube channel. We are going to be dropping a lot of nugget here. So, inefficiency price action is actually different from imbalance. Most of you actually mistake inefficiency price action from an imbalance candle. Imbalance candle is just for candlestick alone, while your inefficiency price action is for price action. What is price action? The price movement, right? Your chart price movement is either the market is actually going up or the market is actually coming down. So those movements is actually what we know as price action. So there's actually some inefficiency there. So, and once you can be able to actually identify those inefficiency and you can actually trade them, it can actually change your trading game, at least give you like 80% winning rate if you know how to actually trade them well. So let's get to class and let me teach you guys how to actually make use of your inefficiency properly. So let's say we have a market, for example, we have a market moving this way, impulse. Let's say we have a break of structure here, another impulse. So let's say this is our wave one. I'm going to be using wave as an example here. I'm going to be using wave as an example. Let's say here is our wave one, and also this push to the downside is wave two, and here is the wave three. So how can you know where is an inefficiency and also how you can know the one that is an efficient price action? So an inefficient price action, these are our wave one that we actually have here. For example, these are wave one that we actually have here. Let's say these are wave one. This one that we have here, and these two, which is this impulse to the downside, and also this correction again, this third one. If the first and the third wave did not touch each other, automatically there's an inefficiency. For example, what do I mean with that? If you look at say now this wave one now, right, that I use this line to actually demonstrate, and also this wave two, let's say this, this wave three rather, that we have here. If you see, this wave one and wave three did not touch each other. So in as much they did not touch each other, automatically there's an inefficiency between them. You understand? So for example, let's say the market just continuously pushing to the downside from here. Automatically, we already have an inefficiency here. And whenever you have an inefficiency, listen, whenever you have an inefficiency in a place, right, no matter how juicy your order block or whatever strategy you are trading, maybe your trend line or maybe your key level is here, or maybe supply and demand. So no matter how juicy it is here, there is 70% possibility that whenever market is coming up, instead of the market should tap into here and create a new lower low for you to the downside, instead the market will induce you out. That is one of the problem that most traders normally face. You see market just kick you out, and at the end of the day the market continuously dumping to the downside. What they do, if you actually go back to your chart and actually look at them properly, you will see that what the market actually did there was just to induce this high to feel the level of inefficiency that is there. Now, after your inefficiency has been filled, that is where you will now jump in. You understand? So your inefficiency price action, if you can actually identify them properly and you can be able to maximize profit from inside and make use of them, you can be able to maximize profit from inside very well. So now let's say the market already feel this inefficiency, then boom, we have a push to the downside. So automatically what happened there, market already feel an inefficiency. So now this is an inefficiency price action. Now let's look at efficient price action, which is the opposite of it, is the efficient. So let's say the market have a push, second push, then we have the third push. You see, both the first and the third, they actually align or they actually touch each other. All right. If you look at it, let's try something. If you look at both the first and also the third, they actually touch each other. So once they touch each other, sometimes it does not mean that it must kiss each other. So sometimes they can actually push more to the more above it and before they actually push to the downside. So automatically this is a what? An efficient price action, a balanced price action. So in this way, if you have another block here or maybe your POI here, you can actually take this POI without being induced because of why there is no any inefficiency there to the downside. You understand? So this is different between efficient and inefficient price action. So today we are going to be focusing more on inefficient price action. And also I'm going to be showing you some trade that we actually took based on this inefficient price action, and also how we are able to actually maximize profit from inside as well. So let's look at here. Anytime you have an inefficient price action, always know there is 80% possibility, 80% possibility, let's say 70% possibility that market will actually induce it and feel that inefficiency. And once market feel the inefficiency, that is where you will now be looking for a way to step in. So you can also use an inefficiency field as a POI. So once the market feel your inefficiency for you, look for your confirmation entry, whichever confirmation you're making use of, make use of them, look for it, and also then you sell to the downside. You understand? So now let's look at chart without bothering you guys with a lot of chat, with a lot of graphical example here. Let's move to chart and see how this actually plays out, and also how we make use of them. Now, if you look at here, I have a lot of examples that we actually make use of this strategy, but let's look at this first one here, right? If you look at here, we have a sell all the way to the downside. We have a sell. Let's say here is our wave one, for example, a wave one, a wave two. Now, if you look at here, wave one, wave two, this is wave three that created a low now. If you look at this wave one and this wave three, they did not touch each other. There is still a gap between here. There is still a gap between here and here. Mind you, structure is still the key. So if you look at the order flow, it's still bearish. So we are still trading based on structure. The order flow is bearish, so we are still selling based on the order flow. Now, if you look at here, we have an inefficiency now. From here to here is an inefficiency. So what we actually need to wait for is for the market to push all the way to feed those inefficiencies. So once inefficiency has already been filled up, what happens? We look for our entry criteria to take our trade. And boom, the market feed the inefficiency with this candle. You see, they push all the way up to feed the inefficiency. Now, you should ask yourself this question. If inefficiency is not actually important, why can't they return from here? Or why can't they just return from here? If you look at it, they actually wanted to return from here, but the inefficiency is not properly fed. There is still a gap between here and here. And at the end of the day, what happened? Boom, they induce people out. Then the following day, when market open, we have that push to the downside. And we actually was able to actually capitalize from it from here. We actually took the trade from here all the way to the downside. Actually, look at this. The second trade that we actually took was from here, right? We have this push, this first push, the second push. And if you look at what happened, we have an inefficiency here, right? Then to the downside. So what are we actually expecting? We're expecting them to feed this inefficiency. And what the market did from there was to just push up to feed that inefficiency. Immediately the market feed the inefficiency. That was where we started looking for a way to actually take a trade from. And we scale down to lower time frame and we look for our entry criteria. Then boom, we took the sale to the downside. So it was a very, very massive profit. If you look at another push again from here, according to what I just said, you see that categorically we have here as another wave one, wave two, right, to the downside. And as well, we have here as the third wave. If you look at here, wave one, wave two, wave three, there is still an inefficiency between here and here, a very huge gap. And what happened from there? We see the market coming all the way up, tapping into that level from there, right? Immediately the market tap into that level, then we have that massive sell all the way to the downside. But I was unable to actually capitalize from this trade, right? But it was still the same strategy, still the same thing. Then look at here, a very, very massive one and a very, very good sell all the way to the downside. So this is actually the way to actually trade an inefficiency. So I can go over and over and show you a lot of examples. So in summary, if you actually have an inefficiency, you always always wait for the market to feed those inefficiencies. And once an inefficiency has been filled, there's high possibility for those of you trading for those of you that are actually trading an imbalance, candlestick imbalance. Once an inefficiency has been filled, there's higher possibility that they will never come back to feed those imbalances again. So those inefficiency, you look for a lower time frame shift or a lower time frame confirmation based on whichever confirmation you're using. Look for that lower time frame confirmation, then you enter your trade. Boom. you capitalize from it. So, and again, whenever, in summary, again, whenever you have an inefficiency above any of your POI based on your methodology that you're actually trading, make sure that you don't take that POI, or even if you want to take that POI, always wait for an extra confirmation before you take a trade from there, because that POI can be induced to fill any inefficiency above before the market be continuously coming down or maybe continuously going up. So if you actually enjoy this nugget, make sure you smash the like button and also subscribe to the YouTube channel, share the video to your loved ones, and see you in another one. Enjoy your day.